Hey there, this is Ryan Skaggs, and this is the Mortgage Minute. Thank you so much for tuning in. This channel is dedicated to everything real estate, mortgage, and interest rates. So, we're going to dive right into those interest rates today. So, mid August, we've seen rates actually move up over the last week. First time in about 6 weeks that we started to see, any sort of trend of just a slight move up. I made videos before talking about, hey, the Fed has told us that they're going to keep rates low or we're going to see low rates for the rest of the year. That absolutely remains true. But we've seen strong jobs report and some other economic data that has slowly pushed up. So according to Freddie Mac, the average 30-year fixed at 2.87. That is up 10 basis points from 2.77. That's a pretty big move from week to week. So someone like myself that watches this day in and day out, that's a big move from week to week. So that was a nice little jump up in rates, maybe an eighth or a quarter in terms of an average 30-year fixed of what you might see out there with no points. Now, check out that link below to Freddie Mac's weekly survey to show, you can see, and it's illustrated of what that average 30-year fixed is and how it's been moving. While you're down there, hit that like button, hit that subscribe. I'd be forever grateful. Subscribe. It's absolutely free, and you get notified if you click that bell icon for the weekly videos that I put out. So thank you so much. While you're down there, like I said, click that link, and you can kind of see where interest rates have been going. I want to talk about today is that what do all 800 FICO scores have in common? What's the one thing? And it's not net worth, it's not age, it's not anything else, right? It is the understanding of credit. And we're just going to kind of breeze over the basics here. But let's talk about it. First of all, I can't tell you how many times in a week somebody will tell me like, oh, I have a really good credit score. It's like 400 or 500. And I'm like, well, no, that's not good. That's poor. Or they tell me I have like a 900. And I'm like, well, that's not possible, right? So this is the scoring model. This gives you an idea of exceptional, very good. But really, what answers the question here is this next piece and how the FICO score or how the score is put together. The number one largest payment history, 35%, right? So obviously you got to pay things on time, but that's only a third. The second is amounts owed. And really, I want to focus in on this one. The amount owed is significant. Is that if you have a small credit card, like say I have one from college and it was $1,000 limit and I spend $800 a month and then I pay that off. Well, when I get that bill and it says 800 to the credit bureaus, I spent 80% of what I have allowable to me. That's your credit utilization. I utilized 80% of that card. That's not good. Okay. If I paid that 800 off prior to getting a statement and then my bill comes out and it shows I only owe $100 or something like that, good news. Now it only shows that you use 10%. That's why it's good to have higher limits, but use the card sparingly on the bottom end, or divide the spending over multiple cards. Now, again, this is just my opinion, my tip. I see 3 to 5 credit reports a day I'm looking at for almost the last 10 years. So I do get to see like how clients are using credit and, what they are. One of the big misconceptions is age, is you can't have a good credit score if you're in your early 20s. Absolutely not the case. Length of credit history, 15%. That's it. The amounts owed, the payment history, the credit misc. If you've had a car loan, get a car loan in your name, pay it on time, pay it off, right? Now you've got a mix. You've got some credit cards. You've got some different things. That is what's going to help you grow that credit score as a whole. So again, understanding the credit utilization is a big one, and understanding how the model is put together for the score to be able to be there. Getting yourself on a credit card or on a parent's credit card or on family on some sort of credit from almost day one, from age 18, from whatever it is, and then being responsible with the payment or cutting it up and just having Netflix, on there and then getting that paid in full. So you've got longer history. Those are all really key parts. Put your comments below, ask your questions. Again, I see these credit reports every single day. I see how people have increased them. And then I've seen how, scores continue to go down as they've been doing things not as aligned with what I'm suggesting. So this is the Mortgage Minute from Ryan Skaggs. Thank you so much for tuning in, and we'll see each other again very, very soon.